Hey, what's happening, guys? Dan Darrow here from Options in Play. So, today I want to talk about butterfly spreads. All right. So, as you go up the level of options trading from basic to more advanced, you're going to begin to want to add more complex strategies to your playbook, and a butterfly spread is slightly up that scale. All right. Um, these are fairly straightforward strategies, though, but there are some key differences between them and your normal bull or bear spread. So we're going to go over it, okay? So first off, a butterfly spread is what is considered a complex option strategy because it contains multiple legs and multiple different contracts, right? It's going to be a combination of both long and short contracts, similar to a standard spread, though. The best way, in my opinion, really, to look at a butterfly spread is that it's actually a bull spread and a bear spread stacked on top of each other, or vice versa if it's a butterfly put spread, all right? And when I go over an example in a couple minutes, you'll see what I mean by that. So similar to standard spread, there's going to be a fixed profit window, all right, and a fixed premium. Uh, but what you'll notice is that too large of a move is actually going to erode the strategy potential, and that's going to be a big key difference between a butterfly spread and then your standard bull bear spreads. All right. Okay. So in this example, I'm just going to focus on butterfly call spread, right? But a put spread, it's just going to be basically the same thing, just in reverse, all right? So very straightforward. Just for this example purposes, it's just going to be a call spread, though. There's going to be three steps necessary to create a butterfly spread. Okay, first, purchase one call. So this is view these 1, 2, 1 when we talk about as ratios. So obviously, if you want more than just one, then this is going to be the ratio, though, 1 to 2 to 1. That's going to be the ratio, all right? So you purchase one call, then you short two higher calls of the same strike. So like those two higher calls are going to have the same strike. And then lastly, you purchase one call further above those two short calls, right? So you purchase one call, which is the lowest, short two calls above it, same strike, and then you purchase another call even above those two short calls to complete the butterfly spread, all right? So this is going to be really, really important. All the contracts are going to have the same expiration, okay? All have the same expiration. And the two short calls should be halfway between the lower and the higher long call, all right? So you want those like smack halfway in between. Otherwise, it's going to change the risk structure of the butterfly spread. So okay, so you want the two short calls to be halfway between the lower long call and the higher long call. All right. Now, looking at the chart over here, you'll see that the profit window. All right, so this is the trade, basically like net premium laid out. Then all of a sudden, once the stock crosses above like the lower strike, all right, the strategy starts to become to gain value, all right, and then it'll cross into like the profit window once you recoup the net debit of the strategy, and then the max profit. So like the max potential of the butterfly spread, we realized if the stock closes directly at the strike price of those two short calls, all right? So that's going to be on expiration day. If the stock closes precisely at the strike price of the two short calls, that's going to be the max profit. But if it doesn't and the stock keeps moving higher, right, what you'll notice is, and this is one of the main differences between a butterfly spread and a normal spread, is that if the stock keeps moving higher, the profit's going to start decreasing. And then once it gets to a certain point, then obviously the break-even point will move back into like a loss territory. And if it keeps going and it crosses above the higher strike, so if it blows through like the lower long call, the two short calls in the middle, and the higher call on top, if it keeps going, then actually you're going to end up with no profit. So that means that it basically nullifies the spread. All right. So that's going to be one of the main differences. If that same scenario played out with like a normal bull spread, then as the stock kept accelerating, like the profit potential would be capped basically right here, right? Because the stock would be through the top end of the short. But with the butterfly spread, if the stock keeps moving higher and higher and higher, and it trades through the top end of the spread, then you actually go from max potential to double strikes, now back to like basically a loss, or maybe you can like salvage like a premium paid. But that's the main difference between a standard spread and a butterfly spread. All right. So the rationale for at the money or out of the money butterfly spreads is going to be slightly different. Okay. An at the money or even really like near the money butterfly spread, it's actually going to be looking for a less volatile move in the stock versus what the option market is anticipating. Okay. So this is going to be viewed as a more neutral strategy that is looking for the stock to stay in defined range. All right. Now, for the out of the money butterfly spread, you're going to be looking for the stock to make a move higher. So in the most recent example, I used the butterfly call spread. So you're going to looking for the stock to make a move higher, but then you want it to stay within a very very fixed range, right? Because if it moves too far, then it'll blow through the top of that butterfly spread and basically nullify the profit window, right? Okay. So, well, going back 1 second, one of the main differences between these two, other than the fact that for the at the money you want a less volatile move, and out of the money you want a bigger move, but then to trade within a very narrow window, is it's going to come down to like net debit. Okay, at the money butterfly spreads will probably be a little bit more expensive than out of the money. Out of the money butterfly spreads. Some of the reasons why people or traders like to target those is because they can oftentimes be very, very, very low debits. All right, so that's going to be another key difference there. All right, so what to look for if you want to target an at the money? We'll start with at the money again here. So what you want to look for if you want to target an at the money butterfly spread? Stocks and consolidations or ranges, or the possibility of either of those developing over the course of the trade. That's going to be really important. Also, what you want to look for, higher implied volatility, but a lack of catalyst on the options, all right? So you basically want expensive options, but no major event to necessarily move that stock, right? So you're gonna want like the best of both worlds, higher implied volatility, but also no significant catalyst during the time frame, all right? Now, for out of the money butterfly spreads, it's fine to look for a stock that may have a large move. Okay, so like for earnings or other events, it's fine. I mean, you could look for a stock that's going to have or is expected to have a big move, but it's going to be really important that it have a well-defined that has well-defined technical levels that you can really structure that spread around. Right. So then the example in the next couple slides, you'll see what I mean more by that. But support, key resistance, moving averages, those are really what you're going to be zeroing in on for those out of the money butterfly spreads. All right. Okay, so I'm going to use AMD for an at the money and out of the money example. So AMD is going to be used for both, and it actually sets up well for both. So it's just one of those unique scenarios. The time frames are going to be different though. So first up, we're going to talk about at the money. So what you notice about AMD just over the last month is that it's in a relatively tight consolidation, right? Buyers at the 100-day, that's the blue line, and then sellers at the 50-day, that's the black line. So for the past month, this stock has basically been treading water in an extremely tight range, right? Now maybe you're thinking, it's been in a tight range, maybe it'll stay in a tight range, right? The October options that expire in the next month, implied volatility, very high, and earnings don't come out until after those options expire in October. So you have a stock that's been range bound for a month. Options are expensive, and there's no significant catalyst coming up during the time frame of those contracts. All right. So just quickly here too, you see like the top of the range 32. Oops. So the top of the range 32, and the bottom of the range about say like 29.50 to 30. All right. So now let's look at the let's look at the contracts, the option chains right here. So with that range in mind, right? 32 the high, about 29.50 to 30 the low of the range. say, like I said, you want to go out through October 18th. Like this won't contain the next catalyst. You can see that the implied volatility in the low 40s, so pretty high. So say you want to do a butterfly spread, you could look at potentially the 29, right? 29, 32, 35 butterfly spread. So what you would do is you would just for illustration here, you buy 129 call, right, for 243. You would sell two of the 32 calls, right? So again, you want to short. So the ratio is 1 to 2 to 1. So you short two of the 32 calls for the midpoint is 96 cents. All right, and then to complete the spread, you would go out 3 points above 32, right? And then you would buy 135 call, right? So the what you'll notice is that it's the ratio is 1 to 2 to 1, and then that those 32 short calls are 3 points, or are basically 3 points either way between like the long call and the long lower call and the long higher call, right? So that those short calls are exactly halfway between. So if you take the midpoints of the 29, the 32, and the 35 calls, that's going to be the butterfly spread is going to run you about 81 cents. All right. So say over the next few weeks, the stock remains range bound. Right. Say over the next few weeks, stock remains range bound and it closes, maybe near 31. Right. So that 29 strike call will be worth 2 points, right? So closes $2 in the money. 32, the two short 32 calls will be worth zero because they both close out of the money, and the 35 strike call that you bought is going to be worth zero because that closed out of the money as well. So the only option that's going to be worth anything is going to be the in the money 29. It's going to be worth 1 point, right? But you only paid 81 cents for that butterfly spread. So that's an example of why when you're looking at the money options, you're looking for at the money butterfly spreads, you're looking for something that's actually not going to move, right? Because you want that implied volatility to really contract on those at the money contracts. All right. So if the stock closes at 31, only the 29 strike call is going to be in the money. It's going to be worth 2 points because it's 2 points in the money. All the other options are going to be worthless. That butterfly spread is going to be worth $2, and you paid 81 cents for it. Okay? Make sense? All right. Now, out of the money example. So, again, AMD, I like it because it actually sets up well for an out of the money butterfly spread too. But we're going to shift the time frame on it. So say, for instance, again, that earnings are coming up, but they're going to fall after that October 18th expiration. So they're going to be a November expiration, right? And in this case, maybe you're bullish and you think they're going to be good, all right? What you'll notice on the chart is that there's a long-term area of resistance around 34 to 35, right? You can see it very well defined. 35 resistance failed multiple times, multiple months, right? So you think it could be good, and you think the stock could break out of its consolidation that it's been in, but it could have a really tough time clearing 34.50 to 35, right? Because it's failed at there multiple times. That's a pretty big move from where it's at, and you think that there's a reasonably good chance that the first time it gets back to it, it'll fill at it again. So you could look at this and think of designing an out of the money butterfly spread around that 35 level, right? Because it's a really significant level of resistance, okay? And you think if the earnings are good, it wakes up, it starts to rally, possibly that 35 could act as like a magnet because it's been a magnet in the past and it's failed at it multiple times in the past, all right? So now let's go to the option chain. So these are November 15th expiration. So they're going to go through earnings, okay? So you can't see it here, but this is November 15th expiration, okay? So 35, right? That's the level that you want to focus on. So you want to design the butterfly spread around that 35 level, okay? So doing the same structure with like 3 points wide. Say you want 35 to be the midpoint, right? Because if it closes at 35 on the dot in November, that's the max profit window for that strategy. So what you look at is the 32 strike call, right? $1.98. You sell two of the 35 strike calls at $1.03, right? And then you go out to 38 and you purchase one of the out of the money 38 strike calls for about 51 cents, okay? So again, ratio is 1 to 2 to 1, right? So that's that particular butterfly spread the midpoints, using the midpoints is going to cost about 44 cents. All right. Now, say that it beats and it runs and it gets up into that 35 area ahead of earnings, right? So the key thing is that this is closing prices on the day of those options expiration. So on November 15th when the options expire, right? Basically, the profit window, like the ideal scenario would be for it to close right at 35. But even then, like the strategy doesn't necessarily need it to close at 35 to be in the money, right? Because you paid 44 cents for it, but if it closes above 32.50 or below 37.50, right, that strategy is going to be in the money. Makes sense? Because you paid 44 cents. So if it's above 32.50 at expiration, then that's going to be in the money. And if it's below 37.50, right, that is still going to be in the money. Okay? So 35 is the ideal target, but realistically, if it's above 32.50 or below 37.50 on November 15th expiration, that strategy is going to be in the money. So it's going to be worth more than what you paid for it. Okay? Makes sense? All right. So to summarize here, butterfly spreads, complex option strategies that are going to involve multiple legs to open and close, okay? They're going to have a fixed risk and fixed profit window, kind of similar to your standard bull bear spread, all right? They're going to be typically lower debit strategies. Out of the money will probably be even lower than at the money. Something to remember. And as is always the case, trade selection is going to be really important because if there's too large of a move, it could really affect the butterfly spread profit window, like the strategy, right? Like we just went over. So one of the main differences between butterflies and your standard spreads is that if it's too big of a move, or even too small of a move, obviously, that's really going to affect the butterfly spread disproportionately. Really disproportionately affect the butterfly spread. All right. Okay, so quick crash course there on butterfly spreads. If you want more information about options trading or if you're interested in actual trade ideas, definitely be sure to follow up with the link in the video description for more info on options to play, all right? So have a wonderful night and best of luck with all of your trades, all right?